In today's video, we're diving into a major financial crisis that rocked Europe in the early 2010s, the European sovereign debt crisis. This crisis threatened the stability of the entire European Union and nearly caused the collapse of the Eurozone. But how did it start? What caused so many European countries to face such dire financial troubles? And what were the consequences? Let's break it down. The origins of the crisis. The roots of the European sovereign debt crisis trace back to the financial conditions in Europe in the years leading up to 2010. Europe's countries, particularly those in the Eurozone, had been relying on debt-fueled growth for years. While the Eurozone was a political and economic union with shared currency, each country had its own national debt. Some countries, like Greece, Italy, and Portugal, had been running high deficits for years, borrowing extensively to finance their public spending. When the global 2008 financial crisis hit, many of these countries saw their debts increase dramatically as they had to implement stimulus packages to stabilize their economies. But, unlike countries with their own currencies, Eurozone members couldn't print money or devalue their currency to manage their debt. This meant they were more reliant on borrowing in international markets. The spark, Greece's debt crisis. The tipping point for the European sovereign debt crisis came in 2009, when Greece revealed that its debt levels were much higher than previously reported. Greece had been underreporting its debt and fiscal deficits for years, and in late 2009, it admitted that its budget deficit was over 12% of GDP, far above the European Union's limit of 3%. This revelation caused a panic in the financial markets, as investors began to fear that Greece wouldn't be able to repay its massive debt. Greece's credit rating was downgraded, and borrowing costs skyrocketed. The European Central Bank, ECB, and other EU countries saw that the situation could spread to other countries in the Eurozone, causing a domino effect. The response: bailouts and austerity measures to prevent a full-scale collapse. The European Union and the International Monetary Fund, IMF, stepped in with bailout packages. In 2010, Greece received a €110 billion rescue package, followed by additional bailouts in subsequent years. However, these bailouts came with harsh conditions: austerity measures. Austerity involved drastic cuts to public spending, pension reforms, tax hikes, and other measures to reduce the deficit. While these measures were meant to restore fiscal stability, they sparked widespread protests and social unrest in Greece and other countries, including Spain and Portugal, where similar bailouts were provided. The austerity measures led to widespread economic pain, unemployment surged, particularly among youth, and economic growth stagnated in many affected countries. The spread of the crisis. Other affected countries. While Greece was the first country to face the worst of the crisis, it wasn't the only one. As Greece's debt issues worsened, other European countries also faced increasing pressure due to high debt levels and slow economic growth. Spain was hit hard by the collapse of its housing bubble and rising unemployment. Ireland also faced a banking crisis, as its banks had been overexposed to bad loans. Portugal, like Greece, had been running large deficits and had no option but to seek help from the EU and IMF. Then there was Italy, whose government debt was the second largest in the Eurozone after Greece. With economic growth slowing, investors started to worry about Italy's ability to repay its debt, triggering fears of a sovereign default. The Eurozone's response: the European Central Bank. To contain the crisis, the European Central Bank, ECB, took aggressive action to prevent the collapse of the Eurozone. The ECB cut interest rates to historic lows and began purchasing government bonds from struggling nations in an effort to lower borrowing costs. This strategy, known as quantitative easing, was aimed at stabilizing the financial markets and boosting economic activity. In addition, the European Financial Stability Facility, EFSF, was created to provide emergency loans to troubled countries. Despite these efforts, confidence in the Eurozone remained shaky. The crisis had exposed deep flaws in the structure of the Eurozone, particularly the lack of fiscal coordination between member states. The political fallout and social unrest. The European sovereign debt crisis had severe political and social consequences. The austerity measures imposed by the EU and IMF were deeply unpopular. In countries like Greece, Spain, and Portugal, citizens took to the streets in massive protests, demanding an end to austerity. The crisis also led to the rise of populist political movements, both on the left and the right. People were frustrated with the handling of the crisis, and many began to question the European Union's role in imposing austerity measures. In Greece, the far-left party Syriza came to power in 2015, promising to fight against austerity and renegotiate the country's bailout terms. Meanwhile, many European governments faced elections in which voters expressed their anger over the economic pain caused by the crisis. The end of the crisis. Signs of recovery by 2014 and 2015. The worst of the crisis seemed to be over, although many countries were still struggling with high unemployment and slow growth. The Eurozone as a whole had started to show signs of recovery. The ECB's aggressive monetary policies helped stabilize the situation, and countries like Ireland and Spain began to see economic growth again. In addition, many countries, including Greece, took steps to restructure their debts or extend the timeframes for repayment. While some economies were beginning to recover, the social and political scars of the crisis would remain for years. The legacy of the European sovereign debt crisis. The European sovereign debt crisis left a lasting impact on both Europe and the global economy. It exposed the weaknesses in the design of the Eurozone, where countries shared a common currency but did not have a unified fiscal policy. This led to calls for greater financial integration and structural reforms within the EU. The crisis also led to a broader debate about austerity and the role of governments in managing national debt. While austerity measures helped restore some fiscal balance, they also led to deep economic pain and social unrest. The legacy of the crisis can still be felt today, as Europe continues to deal with challenges related to growth, unemployment, and the stability of the Eurozone. The European sovereign debt crisis of 2010-2015 serves as a powerful reminder of the dangers of excessive debt, financial mismanagement, and the interconnectedness of global economies. While Europe has largely recovered from the worst of the crisis, it's clear that the effects are still being felt in many countries. What do you think of the European sovereign debt crisis? How do you think it shaped Europe's future? Let us know in the comments. If you enjoyed this video, be sure to like, subscribe, and hit the bell icon for more financial history and insights. Thanks for watching, and we'll see you in the next video.